So, welcome back to another episode of Thinking Outside the Bank podcast. I'm your host, Trevor Hicks, and today I have the distinct pleasure of welcoming Mr. Miguel Diaz with Best Equity Capital. Miguel, welcome to the show, my friend.
Thank you. Thank you. Thank you, Trevor. Appreciate
Yeah.
the invite. Yes.
Yeah.
Awesome.
Thank you for being a guest. And I actually secretly the nerd in me, I'm going to call it that from a real estate perspective, when I think of underwriting, I think of, numbers, I think of, looking at all the things, spreadsheets. And secretly I love that because that's what I'm good at as well, and really have been wanting to learn this and had a good opportunity to utilize your services here recently for a commercial deal we were underwriting. I got some really good output and it made my brain just kind of at ease a lot more, my anxiety a lot more at ease going through it with somebody who's a professional in this. So I want to give you a chance to kind of introduce yourself. Let me know a little, and our guests and our audience know a little bit about what Best Equity Capital does.
All right. Thank you, man. Thank you. Appreciate it. Appreciate the introduction. Um, my name is Miguel Diaz, as you said. I've been obsessed with commercial underwriting for the past 5 years. Totally immersed in this space, fantastic space. My background is that I am a business administrator by degree, right? So I got to that analytical mindset of mine. My mom was an accountant as well, so it's within my veins. But I got into this because I was once, well, I still follow him. I started following Grant Cardone like 5 years ago. And he said, like, if you are good with numbers, you have to know how to underwrite deals. So that was my go-to. And I didn't start in single family. I just jumped into commercial. Of course, later on, when someone introduced me to a single family house, hey, can you do this? I said, like, yeah. And of course, it's easier. But I started in commercial, and that's my point. So the services that we do is that we present feasibility studies, market analysis, market research, positioning, value add, debt structure, partnering structure, all of that according to any type of commercial deal in general, whether it's conventional or creative as well.
Okay. For those listeners that may not know the difference between residential and commercial real estate. When you say,
The main difference is talking about just homes or apartments up to 4 units, it's residential. So a fourplex still residential. 5 units and above, it's commercial,
got
considered commercial.
it took me a while, and a lot of like shaking my head of, yeah, I know what commercial is, and then research behind the scenes. So I figured from somebody who jumped straight into commercial, um, that it might mean a little more. And it's very simple with that. I used to get these long descriptive, but yeah, if it's under four units and under, residential. If it's over 4 units, again, that falls into commercial. So,
Correct.
um, so how, you said you listened to Grant Cardone for years. What were you doing before this business, and how long has Best Equity Capital, been around, and what sparked your interest to jump into commercial real estate and underwriting?
Best Equity Capital's been around since then. I was living in Costa Rica before prior that, and I was in the cell phone industries. So nothing to do with this. So that shift when I came here, I said, okay, I need something for legacy. I need something for long term. And that's why I started doing my research. And then I found out about Grant and his passion about commercial real estate. And then I bought some courses from him about commercial underwriting and, commercial real estate in general. And that's where I started
Awesome. Now, you said you used to live in Costa Rica. When did you move to the United States?
5 years ago.
Oh, awesome. 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 Costa Rica is high on my
Yes.
list to visit. So I will be coming to you when I need recommendations of where to go, where to visit, how to spend
A
my
hundred percent. A
time.
hundred percent.
For sure. Okay. So when we talk about underwriting, okay, most investors hear the word underwriting and they think it's just plugging numbers into a spreadsheet, right?
Mhm.
Your perspective, what is underwriting really about, and what are some of the hidden factors that people might miss?
I think underwriting is everything is based on assumptions. Okay. So I used to compare this, and you know that because you are where into the residential space. When you do a fix and flip, for example, for a residential property, you are once you do your underwriting, you're assuming that you're going to spend X amount of money into that property and you're going to keep it for X amount of months. And so you have your holding costs, and then you're going to sell it for X amount of money based on your sales comps. All of those are assumptions. The more experienced you are in the fix and flip space, the more accurate you are in those assumptions. Once you see the house, once you do a walkthrough and say, "Oh, I need to do this, this, and this. This is $20,000, and it's easy." So when someone is not familiarized with fix and flip, they might lose those because it's all based on assumptions. Same thing into the commercial space. Once you dive into the commercial space, once you have to project, because I tell you, hey, this might be worth X amount of money in 2, 3 years, or these are your returns if you sell it in 5 years, and all of that, it's based on assumptions. The way you can operate a commercial property during those years based on what you currently have as a deal. So if it's a value add that you need to reposition the deal, then you will need to structure it somehow, depending on the size of the property, between 1 or 2 years to stabilize the property.
Okay.
So it's more to compare to the single family space. That's how it is. So it's based on assumptions, and it's based, of course, on your experience and knowledge.
Gotcha. So when I think of assumptions, I think of the old adage, what happens when you assume you make an ass out of you and me. And I remember thinking, going through some of these when we went through our most recent commercial deal with my partners and you on a couple of Zooms, which was fantastic. Um, we kept hearing assumptions, assumptions, assumptions. And my thought process in my head was, well, what happens if I assume wrong? Because only been in real estate investing for a little over a year and a half. How do you help kind of guide and honestly mentor some of these people that you're underwriting these deals based off of their experience to know whether an assumption is really a good assumption with your experience, or whether it's like, hey guys, this assumption, how did you get there? How do you pry into some of those questions when you're working with a client?
Well, great question. So, depending on the asset could be one thing or another. Okay. For example, if it's a multifamily apartment building,
Mhm.
those assumptions are more quote unquote accurate because you have more data. You have rent comps, you have T12, which is the trading 12, the past 12 months of a P&L for the property, and you have the market, you do the market research, and it's kind of easier to project it in time. And then you do kind of risk mitigation, and then you see, okay, let me see how can this go, like between worst case scenario and best case scenario. But in the case of your deal, which was a little bit more creative because you have so many different ways to produce money within the asset, then we go to the numbers and see, okay, what is the worst case scenario based on this, and what would be um, basically you rely on the data that you have. That's why it's important to have as much data or information from the broker or the seller so you have something to work on. So once you have that, then you say, okay, what would be my worst case scenario here based on this, what I have? And then that way you say, okay, if this worst case scenario works for you, Trevor, then we're good to go.
That's great. And I love how you bring up worst case scenario, best case scenario. Because yeah, before this deal, this was a commercial deal or business we were looking at. I underwrite mostly fix and flips that my partner and I want to make an offer on, and we always are conservative with our ARV, meaning we maybe the house will sell at 450, we may put it at 430, 435 because you don't know what the market will do over the next 3 to 6 months. You want to be conservative. Say I put it as, oh, let's say it's going to sell for 460 and we're only going to spend 60,000 worth of rehab. We could inch out that, extra 10 grand. We'll put in some sweat equity. No, we're going to overestimate that and, factor in those numbers because we make the money on the buy, not on the sale. So
Mhm.
I love that again. And when we did our underwriting with you, I said, hey guys, these are conservative numbers. And if you like those, it's only upside from there. So I really, really like that you lined that out when we went through that commercial deal and really opened my eyes to a lot of things as I kind of continue on this path. So thank you for that and did an excellent job as well.
Awesome, awesome. I'm glad I brought that to you.
Yeah, for
That's
sure.
the whole
I'm,
idea.
I'm just sad that now we're waiting on that deal we had, and I know you saw the structure of it. For those that didn't, we had a relatively high down payment, but we had structured it with a 5-year balloon for the rest of the seller financing portion at 0% interest. So we got very excited because of the cash flow we were going to be able to produce every month and really be able to, pay off that seller within that 3 to 5 year time frame and have a pretty good size exit and get all our investors out. So we're hopeful that again, the deal that they accepted instead of ours, it did not involve any seller financing. Coincidentally enough, they got it the same day that they verbally accepted our offer. We're hoping we'll go back to that and maybe have to plug in some more numbers and rerun some things with you, but
Yep,
to
yep.
come, to be continued. So
Yes, and one other thing about between the difference between a single family and commercial is that um, it's more of a long-term game, more long-term play than residential, as you just said, and that's why I got to this because you said on your fix and flip within 3 to 6 months. So you make the money between 3 to 6 months. In the commercial space, it's more a long-term play than residential. That's why sometimes it's hard for people to transition from residential to commercial because it's a total different mindset.
very, very much so, and especially coming from someone who's I like to think of myself as having pretty good emotional intelligence, meaning I can look inside and say, this is who I am, this is my mistakes, these are my pros, these are my cons, strengths, weaknesses, whatever you want to call it. I'm very much so that likes, a quick return, somebody who likes um, to see the fruits of my labor sooner rather than later. But as I age and as I've gotten into my mid and later 30s, realizing creating legacy, creating that long-term wealth, there's got to be some play in that too. And I saw that for the first time and really got excited with that of the ideas of some of our returns in 3 to 5 years of now that sweat equity, that long-term play. And I almost describe it as when I was younger, I loved to play all these sports, soccer specifically, where it was sprint to from the ball. And then as I got older, I loved more endurance, marathon, Ironman things. And I'm like, man, I'm finding a parody to my life and an analogy, I guess I should say is a better word, of how I've progressed in my investing career now too, is I'm ready to move out of the residential space other than fix and flips for active income and now moving into more of these commercial deals, business deals that, yeah, you're looking at 5 to 7 years or more. But the returns long term and legacy and foundation, all those things are pay off a lot more. So thank you.
Correct, correct. Of course.
All right. So when we talk about red flags and green lights, so you think of two opposite ends of the spectrum. When you're looking at a deal, what are the top 2 or 3 things that immediately tell you if the deal is worth pursuing or if immediately the deal's dead in the water?
So that's a common question. It's a great question. It's a common question that I always try to answer the same way because it always depends on the investor criteria. So I need to understand what Trevor Hicks wants for his criteria to see if this deal makes sense for him or not. Example, as you said, I want to buy it and hold it because it's just you. You are the only investor and you want to buy it and hold. That will be a different, I need a different outcome than if you want to buy it and sell it in 3 years because you're raising capital. So when you have different perspective and different criteria, that you need the deal different. You need different deals. You need different outcomes. So if it's a good deal or not, it depends on you specifically as an investor. There are people that they don't care about the cash flow because they need to sit money there because of the tax benefits. For example, in commercial, the tax benefits are even more than in the residential space. So that's why one thing, maybe if it's just you as an investor, you will just be aware of the cash flow, the cash on cash return. You don't need to get the other metric, which is internal rate of return, into the game because it's just for you. You don't need that. But if you're doing a syndication or if you're doing a fund that you need to complete a cycle between 3 to 5 years, then you have to take in consideration the internal rate of return because you are raising capital from other people. And to be a little bit more complex in the answer, the different type of assets also, and classes, they will give you more returns or less returns. For example, I don't know if you follow Grant, but he just buys AAA A class multifamily. That's it. With those type of assets, you have more appreciation in time because they're newer assets, right? But you will have less cash flow. But and you will have less cash flow because it's more stable. It's a more stable investment, right?
Hmm.
If you buy, before he shifted onto this, he was buying value add CB type class properties that to add value to those and get money out of them. Those type of money they appreciate less in time because they're older, but they cash flow a little bit more. So at the end, you have two different strategies, but on top of that, you have your investors. When you raise capital, what type of investors are you raising capital from, and what are their criteria? Because one thing is you, Trevor, as an operator of a commercial property, but on top of that, who are you raising capital from? Those criteria is important because that's where you have to set. When you raise capital, you say, okay, and I don't know, maybe you know that from the residential side of fix and flip, how much you want to earn from this.
Yep. Yep.
What's your return? Oh, this. Okay, if I find a property with this type of returns, you want to invest with me? Yes, that's your criteria. So that's your buy box, and then you start from there.
You got it.
So it depends on what you want specifically from each deal.
That's good. And I know a lot of people don't like that answer. It depends, right? But I think the truth is it really does. Everybody wants the black and white. Everybody wants the smoking gun of Miguel. No, I wanted one tip that tells me if this is a good deal or not. Well, it really depends. And I think I have come full circle with that because at first I got into real estate investing thinking, oh, I'm going to go buy 10, single family homes that all cash flow $500 a month each, make $5,000 a month and be able to start looking to, retire from my W-2. Well, those deals are getting harder and harder to find, first of all, because the good deals a lot of times don't hit the market. You don't hear them. They're relationship driven, and I love that because I'm a relationship based person, always have been even through my W-2. Um, but also it depends on there's those high earning income, individuals that need to park their money somewhere for tax benefits. And I think you hinted at this, and one thing that I don't know the difference of that you said tax benefits are better in commercial than residential. First of all, why is that? And even if you start maybe with for those high income earners, when we talk about parking their money or taking a tax benefit, would you mind expanding a little bit as to your knowledge on that of how that works or why there's a tax benefit?
Well, first of all, I'm not a CPA, right?
Perfect disclaimer. Neither of us are. So there you go.
Yes, correct.
Secret
Nor
CPA
are tax
advice.
strategies either. But what I mean about that is when I don't know if you have heard of the term cost segregation. A cost segregation, your depreciation in time for the asset you bring into year one, and that will offset you from your income. So if it's a high earner, if it's a high income earner person, doctor, 400, $500,000 a month or a year, whatever they do was a high income earner. Once you transition, once you pass that tax benefit to them because they're part of your LLC somehow and they're part of that asset, that will give them the tax benefit of X amount of years. If
Okay.
you do that by yourself, and let's just assume just one person, then you have, of course, the same thing. However, the difference, why is it more on commercial than residential? Because it's worth more
Got it.
and it has more to go through because when you do a cost segregation, they take out each element of the property. So if it's a commercial building, 10, 20, 50 units, they take all of it, renovations and everything that it's in there, and they take out the land because you cannot do the land. It's 20%. So the other 80%, that's what it brings you that benefit for tax purposes. So it's one key thing that it's once you if you need to, of course, but if you're raising capital, that's part of your pitch as an investor. They say, hey, all the tax benefits, 100% of what it is, I'm gonna trespass it to you.
Gotcha. Gotcha. I read about this a few years ago when I was getting into real estate and I heard, all the benefits of it, appreciation, depreciation, cash flow, all of the things. And I heard about cost segregation because, and I think you said it well, is say you have $100,000 single family home. I don't know where you find that anymore, but I know they're out there still. You take
Yes.
20% out of that, which would be 20,000, which would be the land cost. That's an estimate. $80,000 depreciated over, I believe it's 27 and a half years, correct?
Mhm.
So you take that and you divide it up, 20 divided by 27 and a half, and you can take that each year in terms of a loss on your taxes. So say you made $100,000 a year, that 80,000 divided by 27 and a half, you could use that per year. But with a cost segregation study, you can actually speed that up, right? You can take multiple years. I believe there's a percentage, and I don't remember the correct percentage. You can take that upfront in year one, right?
Correct.
So
Correct.
if you had,
So, and let's say you have $100,000 income, and then you from that $80,000, you get, I don't know, $50,000 of cost segregation, just to make an example. Then you have your $100,000 income minus your $50,000 of tax of cost segregation. Then now your income is $50,000.
gotcha.
So just transition that into a bigger, more zeros on the right, and then
Yeah.
that's when it gets sexier.
Yeah, I agree. And I think as somebody who really, the only thing I ever knew in my W-2 world was, money that I contributed to my 401k and my kids. Those were write-offs. Those were, deductions on my taxes every year. So I know a lot of people are always looking for that, especially my high income earners. I worked in healthcare for a number of years with doctors, physicians, anesthesiologists, people that make a lot of income. But really, the big changing that I had when I read, Rich Dad Poor Dad was it's not about how much money you make, it's about how much money you keep at the end of the day. Because a lot of these people, the more money you make, the higher you are taxed, uh, depending on, what tax bracket you fall in. And again, I have friends that are CPAs and work with mine. And I've been introduced to the new form of tax strategy, which is somebody who not only does your taxes at the end of the year and balances things for you, but also gives you insight on some of these strategies throughout the year that are really, really powerful, like these things that we're talking about. And again, neither Miguel nor I are tax strategists or CPAs, but that is going to be some of my next guests that I have on here to talk to people like this. Because yeah, as a real estate professional now, as an investor, I'm always looking to raise more capital. And I think something you said from Grant Cardone, if people know that name, that's a big name in the commercial real estate space. And even people like Grant aren't buying these assets with their own money. which was a big mindset shift in my mind. It's like you have to be a real estate investor. You have to have millions and millions of dollars to get into this, right? And I think you'll agree with me. Some people may use their own cash, and maybe they're, for whatever reason. I'm not here to judge, but the more I got into it thinking, and I remember Google searching, how do I get into real estate with little to no money? Because at the time, all of my W-2 money was going straight towards paying bills and, you know, funding our life. And I wanted other ways of bringing in income to fund that perfect life, to fund other things, and to have, ultimate long-term wealth. Talk to me a little bit about some of the deals that you underwrite and even just a general percentage. How many would you say that these investors are actually raising capital from other private investors or from a fund or whatnot?
I would say um 80 to 90% are they raise capital, but it will depend, and I'm going to use the word depend again because it depends on your goals. Like I know someone, he's a mentor of mine. He teaches work by himself. That's it.
Hmm,
And he doesn't use any others, it just the other people's money that he uses banks.
got
That's
it.
it. He doesn't raise capital. So he has everything in-house, property management in-house and all of that. So it's, but that's when it shifts.
Yeah,
But it depends on you. Like, hey, I don't want any partners. So okay, just
yeah,
grow yourself and that's it. Just by
yeah.
yourself.
That's
It's
good.
if it's doable, yes, I've seen it,
Yeah,
but maybe there's people that say, no, I want like a private equity firm. I want to have $30,000, 30,000 doors under my management and owned, and I need to raise capital. If you want to scale that big, you need to raise capital for sure.
gotcha. Gotcha. And I have another question for you, and it relates to creative finance. Obviously, this podcast is called Thinking Outside the Bank. We're going to talk some about creative finance, and creative structuring of deals. When you mentioned this mentor that uses banks, that's the way I used to think too, is, to go get a rental property, I needed to go get a DSCR loan, which we've talked about in episodes past, which is debt service coverage ratio, meaning if the debt service or the amount that I owe to the bank every month is going to be covered by the investment or the person who's renting my home, the bank will give me a loan. However, I need to put a lot of times 20-25% down on that asset. So if it's a $500,000 house, I'm coming with no less than $100,000. Well, not a lot of people have that sitting to put into one asset to then maybe make two, three, four, $500 a month in cash flow. If you do the numbers, that's not the greatest, cash on cash rate of return. It's not bad. Again, for a high income earner that's looking for purely depreciation, not looking for, cash flow. But I started looking for other alternative means and methods. So in today's market, we're seeing more creative structures like subject to or seller financing. How do you, as an underwriter, look at these deals differently compared to maybe traditional financing means like an SBA or a commercial loan?
Um, the well, let's say the approach is the same one. Okay, it's the same thing. However, when you have a creative deal in front of you, the good thing about this is that you can negotiate. You cannot negotiate with any banks. That's it. They send you, let's say you have a mortgage broker, and he will send you a term sheet of two, three banks, credit unions, or whatever. That's it. Those are your options. Then you decide which way to go. But so you have no room to negotiate. On the creative side, that's where you have that specific room for negotiation. And I tell you a no more than 5%, no more than 6%. Let's try to negotiate interest only for the first 2 years. Let's try to negotiate that instead of paying a monthly interest, let's say we're paying it at the end of the year just one time. So you have different strategies, and it's of course even better. I structured a commercial deal a couple of years ago, and we set different interest rates during those years. Like we're starting the first year, what I think it was like 5.25%. Then second year was like 550. Third year where that was like 575. Then fourth year and on 6%. So you're able to do that, first of all, to get more attention from the seller. Like, oh, I'm going to start earning more in time. And of course, it's attractive to them to say yes. And on top of that, it helps you to stabilize the deal. For example, in the first 2 years, you're paying a little bit less, you're getting a little bit more cash flow, but you're stabilizing the deal in time. So it's more convenient for the buyer to go on the creative side than the conventional side.
When, as a seller, would it be advantageous for them to do creative finance? Because I hear a lot of, and we see a lot posted on social media, and this subject to deal, and oh, this isn't good for the seller. Yeah, it's not good for the seller in some ways, but again, it depends on what their goals are. Um, are there any instances that you would suggest that creative finance actually would be better for the seller than a traditional sale?
Yes, I used to go out some meetups, small meetups and speak on those. And when I talk about creative financing, the key word is need. So if the seller has a big need, then it's good for them. It's beneficial for them for sure. So if they need to sell, because there's two things, if you want to sell or you need to sell. If you really need to for whatever reason, then that's how creative gets into the place. And then you have to do something. But it benefits both parties at the end.
I really like when you said that. Do you want to sell or do you need to sell? Because yeah, when I think subject to, a lot of times when we listen to Pace, and obviously that's my mentor, um, why not? He always asks, why not list it on the open market? Why not list it with an agent to get top dollar? Well, A, I don't have time. It's not in the condition that the realtor told me it needs to be. I can't afford another payment. I just need this off my hands. I need to get rid of this.
Exactly.
The other instance I would say, and one that I was thinking, is maybe somebody who's owned the asset for a long time and who was an investor themselves and bought it really low and it's appreciated. They bought it for 100,000, now it's worth 500,000. They have no debt on the property, and if they sell that and they're not going to 1031 and exchange it into a bigger asset, they're going to take a large capital gains hit. Now, there's some savvy investors that, yeah, I want to sell this because I'm going to invest it into something else. That's where 1031 is very beneficial. But if it's somebody at the end of retirement or whatnot, we're looking at an RV park where this gentleman bought the land years and years and years ago in the middle of nowhere, Kentucky, and has now made it into this big, beautiful RV park, horse farm, and wants to sell it for $1 million. Well, he bought the land for 15,000 25 years ago. So again, that's an instance where you're going to pay capital gains on this. So he not only wants to sell it on seller finance to defer some of that capital gains over years, he needs to. That's what he said to us initially, and ultimately, that's how we want to buy it. Because A, it's a mom and pop that hasn't kept the best books. So when we go to a traditional bank and they now want to underwrite this, well, mostly he accepts cash and check. In this day and age, that's really hard to track. And honestly, they don't track it very well. So part of it is the relationship we've built with him, the trust that he's built with us as the operators to come in and buy this asset, but also realize, there's some value in this that maybe a bank's not going to see because they look at the black and white, the numbers, and his books just aren't there. So that's another instance where I would say, creative finance, specifically seller financing, which I love, would be of benefit to the seller as well. Do you agree?
100%, 100%. Those type of assets like RV parks, mobile home parks, mom and pops, that they don't have they don't keep track of the numbers. That's when they need, at some point when they want or need to sell, there's no other option than creative financing because the banks will ask for the 2 years of T12, like P&Ls. And if they don't have that, there's no option for them. Just they need to sell creatively. That's it.
Yeah. Yeah. That's good. Um, going back, I have two more questions to kind of round this out for you. So, where do most investors go wrong when they underwrite their own deals, and how does that typically cost them?
Great question. I think is when you get too optimistic because you really like the deal. That's where you and it's the same thing in I think in all aspects of real estate. When you get so optimistic, like you said, I know I can sell this house for 470, and you know you can't. You might, yes, but you don't know that, right? So when you're too optimistic on, let's say, rents, that you're going to increase the rent at some point, and the market is saying something different, and then you think you're going to have some returns, and at the end you didn't, right? So it's a thin line, and and more important when you're buying bigger assets and you have to raise capital, you're not guaranteeing any specific returns, but you say to them like, hey, this is my target return for you. So if you didn't do it conservatively, then it's not going to go well in time. So it's better to tell you that it's going to be 10%, and then at the end I over deliver and I get 12% for you. You're going to be happier than if I tell you, oh, it's going to be 14%. You're going to be so excited. You're going to give me the money, and then it's going to be 12%. So,
So what I'm hearing on was two things, twofold. And I've fallen victim to this as well because when we first wanted to get into real estate, right, we wanted to own a cabin in the mountains that we could go and utilize for ourselves. So it wasn't so much about how much is it going to pay me per month. I just wanted to know, is it going to cover its own expenses for me to rent it out and then me go use it 2, 3, 4 weeks out of the year, family let them use it. It was that emotional attachment. I was willing to pay top dollar because I wasn't necessarily thinking of it from an investment. I was thinking of it from an emotional standpoint. I could see and envision me, my wife, my kids, my parents, my siblings, my sibling, and their family there enjoying it. So the value there was in that. But now thinking of an investor, putting my investor hat on, I still have to catch myself sometimes of like, don't get over emotional about the deal. Don't count your chickens before you're hatched. Until that money is deposited in your account, nothing's final. We've all seen real estate deals can go sideways. Sellers can go crazy. I've had those too, where, we had an investment property in North Carolina, very creative deal with the Morby method, and the seller, like the week before closing, was like, "Nope, I'm not selling to you guys. You guys, I'm not extending the contract, and sorry, nothing can be done." And it was like, "Wait, what?" So not to get too emotional, not to get too attached with the deal. The other thing too, I think that you said really well there at the end was you want to under promise and over deliver versus over promise, under deliver. Otherwise, people aren't going to want to come back and reinvest their money with you. You tell them they're going to get 15% returns, and it comes to that quarterly draw, and you're like, well, we're only at 10% and it's going to be about a month late. They're going to really think second time when they come around to invest money with you again because you overpromised them and underdelivered. So I've become
correct.
really cautious of those people coming and pitching, oh yeah, I'm going to give you 25% return in 3 months and it's going to be in and out, it's easy, just based on this refinance and da 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 da. I've been able to pick up on that now because I've had to go out and raise my own capital, so I know what to look for, I know what to listen for, and there are that throw caution to the wind when something sounds too good to be true. Just like any aspect of life, be cautious, I would say.
Exactly.
Healthy
Exactly.
skepticism and optics is very important.
Yes. Yes. And the
Um,
the key word here is conservative. So you have to be conservative.
yep. Yep. And we're not
I
talking
I I
small.
had the chance to audit. There was a client that said, "Hey Miguel, I have this." They're asking me. He's like big investor, but he is a developer like for 30 years, but he's just by himself, right? And he was kind of, entertaining the idea of be a key principal, a sponsor for syndications. And then someone sent him something and say, hey, Miguel, I need you to go through this to tell me if they're underwriting it correctly or not. because I'm not 100% into this syndication style of modeling and all of that. So they sent it to me and they were wrong. And he said, "Look, oh Miguel, thank you so much because you took away something that's gonna was gonna be a headache for me." And
That's
they were not conservative at all.
that's excellent. And
Because I'm sorry, because there's something that for us, I'm gonna say for me, as an analyst, you send me a lead and I have the ability to turn it into a deal. Now, how much I'm willing to push it to make it a deal or not. That's the thing. So if I have to push it so hard, then I'm not being conservative. I'm going to get the returns that you want, but I'm not being conservative. So that's that thin line when you have that back, well, back where we were talking about the assumptions that you say, okay, these are my assumptions based on this to make it a deal. And that's when you said, okay, then the only way that can this can be a deal is at this price. Okay, that's it, period. Nothing else.
yeah, I was gonna say you can make the numbers perform how you want them to. You can get the return you want, but at what cost? And again, you pull those levers, but things still have to, go the right way. So if you're conservative from the get-go and it looks like a deal, then it's like, wow, maybe this is worth pursuing. But if you have to push them so far or come up with a ton of capital or give a ton of equity away or whatever it may be, you really can, the underwriting and the analysis can really save people from a deal. So I cannot impress upon everybody, and we've only underwritten one deal together, but I had a healthy level of skepticism for that deal because I didn't know what I didn't know. And I reached out to, a good friend and colleague of ours, Javier Paredes, who's been on the show before, and he recommended you by name. He said, don't go anywhere else. He will either tell you if this is a deal or not, and he'll put your mind at ease. And at the end of, those two Zooms that we did on back-to-back days, I felt so much more confident walking into this deal, not only as an operator, but also as an investor and going and raising capital from people and saying, hey, this is a deal and here's why. And I think that confidence and that peace of mind was, so worthwhile because then I could go and sell that deal. I had confidence when we were going to go raise capital for this and hey, this is a deal. Here's why. Here's your returns. We're confident on this. This is going to be the low end. We're going to under promise. We're going to over deliver. And even talking to that seller of like, hey, he didn't want to hold the note for 5 years. And I went to him and said, hey, we're pretty confident that we can get you out before those 5 years, but I'm almost 100% will get you out at the 5 years, if not before. And it really was able to, I think, truthfully sell that deal to him. And again, give us that verbal confirmation of our deal. But yeah, still more to come. So
Yeah, yeah. And that's something that I really like to do. Those Zoom calls, I think they're personalized and it's good because you as an investor understand everything and you have the time. It's not just a PDF with a lot of words. It's something that you ask questions and okay, but why did you do that, but why did you come with this and why this and why that, and that way you understand that even better. That and that's why you're saying that then you have the confidence to go to talk to someone about the deal because you understood it, the whole thing.
that's great. That's great. Now you underwrite mostly commercial. Is it mostly local to Orlando to Florida, or you do it nationwide?
Nationwide, anywhere.
Um, okay, okay. What would you say, and this is probably one of my last questions, and I might make it a two-parter. What would you say is unique about the market right now that makes it stand out compared to other times, in your history of underwriting over the past few years? And also, what's one of the most surprising and memorable deals you've underwritten and why?
Let's talk about the market first. It's been on the commercial side, it's been tough years, the past 2, 3 years. Once the interest rate went from 3% to 8%, I mean, 1 year. So, based on assumptions, right? At that back then, when you had 3% interest rate, prices were very high, and at 3%, basically anything cash flowed. a lot. So the thing is that they said, okay, I'm gonna underwrite this at 3%, and let's say worst case scenario, I'm gonna sell it and I'm gonna refi it at 5%, 6%. Like, oh, that's crazy. And it wasn't like that. So that is something based on assumption, and it was like a huge deal that nobody expected that at all. That bump on the rates, right? But that's the point when back then people didn't think about buying a cap for the interest rate. So yes, I'm entering at 3%, but I need and of course there wasn't a fixed rate. Um, and even though it wasn't a fixed rate at 3%, like yeah, of course it cash flows like
Yeah.
crazy.
Yeah.
So that's when you get those emotions in place, and then of course um, that is nowadays they're getting into troubles, of course. There are a lot of commercial deals are being foreclosed, or there are some financial institutions that are trying to do something with them, like partner it up with them so they can keep going. But at the end, nowadays, that is kind of getting into that stable market, to say it somehow. So I think we're starting to get on the upper side of this. That's I think it's on your question about the market, and on the other question about a deal, I think one though that commercial deal, I think that was the one of the best ones. Creative financing, seller financing. It was 25% down, but it was a seller financing. It was like I think it was like $4 million deal, probably. And it was different type of rate, interest rates in years. So you had the chance to negotiate with the seller. And I think that's, it's the good thing about the seller financing. It was like 30 units, mom and pops, uh, but totally paid off, and it was a great deal.
That's awesome. That's awesome. Well, yeah, I want to be respectful of your time. And I think there was some amazing responses to some of these questions today, man. And I want to thank you, so much for some of the information that you provided for the listeners from the underwriting perspective, the commercial. We talked about, market trends, what's happened over the past couple of years, creative finance. I think we've touched on just a little bit of everything. Is there anything else you want to share from that maybe we didn't get to hit on, and from your experience that you think the listeners might be able to take from you?
I think not. The only thing that I missed here probably, and just to let you know that I'm part of it as well, because when I told you earlier at the beginning about a feasibility study, that's something that I'm into as well. That it's for me it's phenomenal and fantastic, which is ground up development when you really project uh, big apartment complexes in time. So it's something else that I really enjoy and like because there are so many moving pieces and factors in place that it's something that it's amazing when I actually finished two 150 unit apartment building and another 80 unit apartment building from a couple big customers, investors that they want to develop that. So they bought the land and okay, why is it going to be? So have it's going to be a multifamily. Then of course this is my time frame for construction, and then the operating side of it, and then you project if you hold it for 1 year, 2 years, 3 years, and it depends on the cash flow and all of that. So
Yeah.
I think it's fantastic.
So you said you do a lot of underwriting for those type of bigger investors, those, and
I have.
that's what you enjoy the most, huh?
I have both of them. I have both of them. Existing assets and ground up development as well.
So have you? when do you decide of after underwriting some of these of like, hey, I want to invest some of my own money into these? What other than just underwriting these, what's some areas where you've been like, wow, this is a really good deal. I feel like you get to see some of them firsthand and then go to that investor and say, hey, could I invest in this? Or what's your take on that?
Yes, I think for me, and based on my background, what I have experienced working with as an employee for investors, right, in the past, is that operators. I think that's the only key there. Operators. I would invest in something that I really trust the operator because you're putting your money like if you do fix and flip, right? I'm giving you $20,000 tomorrow for your fix and flip. I'm trusting you and your
Yeah.
experience. So it's different that if you do it by yourself because you're getting into, yourself,
Yeah.
right? But if you're not, then you have to trust that operator. And for you, in a fix and flip, during the difference, the fix and flip would be 3 to 6 months, and that's it. But in a commercial asset that we're talking about 3, 5 years, you're signing a marriage, basically. You're
Yeah.
getting married with those people for 3 to 5 years.
Yeah. That's longer than some marriages last, unfortunately.
Yes, totally
So,
agree.
so what I'm hearing you say is if I was listening to this show and wanted to get into some investing and wanted to put money and park some money somewhere, and I know a lot of people that do, you're saying start with people that you know, like, and trust, maybe that are have a track record already in that space and aren't just like, hey, I want to do my first fix and flip. I need Uncle Joe, I need $100,000, which admittedly enough, that was me a year and a half ago, went to family and said, I need you to trust me. And they did, and it's become prosperous and haven't lost any of their money yet. And actually given them pretty good returns. But if somebody was to get into this space and say, "Oh, I want to invest in this," you'd go with somebody that you again know, like, and trust, know that they're already in that space and are doing well in that.
Yes, yes, in every aspect. I would ask, and that's part of it. You have to ask for the track record. It's important.
Absolutely. So doing your due diligence with them, not only on the asset but also on the person. And I say that all the time when I'm
Yes,
underwriting a
that's
deal is it's yes, it's about the numbers, but I'm again big relationship person that I have to trust that person and build a relationship with them. And so many times in a lot of these communities we're in, as people make a post of $50,000, 3 month, 20% flat rate return, and they give no details on themselves as to why, you should trust them first and foremost, what their experience is, how they're going to protect your money, all of those things. And people just see dollar signs and they get drawn in by that. And they must be in this community. They must be a good person. And I'm finding and uncovering a lot of stories where people have gotten burnt because of that. And I'm also, being cautioned against it. When I respond and say, hey, I'd look at doing this deal, and people are like, oh, why would you lend to somebody you barely even know with no equity? I said, I wouldn't, but I want to get to know them. I want to build a relationship with them. And if they're willing to do that, it's going to make me trust them a whole lot more as an operator versus just like, I need your money, I need it tomorrow. Like, that's why that's a red flag.
mm,
Pace says that all the time. If they're urgent with needing your money, that may or may not be a very good scenario to get into versus an operator who's thought this out and is raising capital in advance. And that's why it's so important of, hey, I don't have any opportunities right this second, but I do 2, 3 deals a quarter, and I may need your capital in the future. I'll give you a pitch deck, and you develop a relationship with that person before just popping giving them 20, 30,
correct.
50 grand. So
Correct. And most important when you're doing those long-term relationships, like 2, 3, 5 years of, being operator and investors and all of that, it's important as well on the cores and values, principles and values that you have to resonate with them. Actually, I've heard a couple of times people say like, hey, I have rejected $5 million check from someone that I prefer not to do that with them because I'm gonna, like it's going to be so intense and toxic that he said, yeah, you know what? I'd rather not.
yeah, I'd rather not. I think that's perfect, man. So, well, I want to say a big thank you to our guest today, Miguel Diaz, for breaking down the world of underwriting and showing us what really makes or breaks a deal. If you guys caught anything today, it's that the numbers don't just tell you a story, they reveal the truth behind whether a deal works or not. And what I would say is if you want to connect with Miguel, if you want him to underwrite your next deal, check out his work at bestequitycapital.com. You can see it there behind him if you haven't seen it already. And give him a follow on Instagram at mdiazrei on Instagram.
Yes, sir.
That will all be tagged in the show notes below. And guys, if you found any value in this conversation, please make sure to subscribe to Thinking Outside the Bank. Share this episode, follow us on Instagram, share it with another investor in your circle, leave us a review so we can continue to bring on experts like Miguel. Yeah, and until next time, please keep pushing past the box and thinking outside the box. So thank you guys.
Thank you, Trevor.